With tariffs now officially enforced, investors need to understand what's happening and how to position their portfolios. Today's video will provide a straightforward analysis of the current situation and what likely comes next. We're witnessing a critical economic turning point as new tariffs take effect. Vietnam's case exemplifies the broader issue. They charge 90% on imports, while we're implementing a 46% tariff in response. This imbalance highlights the challenges in international trade that are now directly impacting markets. From an economic perspective, examining the timing and impacts of these tariffs provides essential insight for investment planning. Despite uncertainty surrounding recent announcements, we need to analyze what's happening now, what might happen in various scenarios, and how investments should be positioned for optimal returns during these volatile times. The tariff strategy debate features two distinct perspectives. One argues we need equitable free trade among all nations. Either other countries agree to a fairer system, making these short-term measures, and they agree promptly. But what constitutes promptly in international trade? A week? A month? 6 months? The ambiguous time frame of perhaps a few weeks leaves markets in a difficult position. The second view suggests the strategy lacks clear definition. We simply don't know the who, what, where, when, or why behind the trade strategy. Besides that significant gap in understanding, everything is perfectly clear for market participants. Most people understand tariff mechanics by now, but to illustrate further, imagine a game demonstrating how escalating tariffs become a competition without true winners. Though inflation certainly gains momentum from the situation, creating additional challenges for consumers and businesses. We now face the reality of implemented tariffs and are witnessing market reactions across sectors. This represents our economic situation for the foreseeable future. 3 potential paths lie ahead, each requiring appropriate investment preparation. 1. Short-term resolution. Tariffs persist for 6 to 8 weeks until countries negotiate fair trade solutions. 2. Escalation. Tariffs intensify with each retaliatory cycle, potentially lasting many months and creating substantial economic disruption. 3. Quick reversal. Tariffs are abandoned within weeks due to economic pressure. In the first scenario, if countries reach a solution within 8 to 10 weeks, we'll witness substantial market spikes with unprecedented reinvestment levels. Having investments already positioned before this news breaks would be advantageous, since many superior market days occur during downturns or immediately following significant declines. This timing is virtually impossible to perfect. The second scenario, with escalating retaliatory tariffs, would likely have catastrophic consequences, pushing the economy toward recession. Here's what this might look like across market sectors. Currently, tech sector growth stocks have suffered disproportionately steep declines. Tech consistently represents the vanguard of market sentiment and fear, which follows established patterns during uncertainty. Many investors have abandoned tech positions and increased cash holdings, or interestingly, shifted heavily into actively managed ETFs. Active ETF assets under management have exceeded $1 trillion for the first time, now representing almost 10% of total ETF assets. Conventional wisdom suggests people trust professional management during turbulent periods, believing it will outperform indices, despite statistical evidence showing index funds typically outperform most managed funds over time. Regardless, tech stocks have absorbed the harshest short-term impact, and with tariffs now implemented, retailers and manufacturers will likely experience significant sales increases as consumers attempt to avoid price increases. This will create a misleading positive signal in economic reporting that should be disregarded when making investment decisions. Most manufacturing and retail operations maintain only 2 to 4 weeks of safety stock for demand fluctuations. For perishable items with brief shelf lives like produce, effects would manifest within approximately 2 weeks. Consequently, the next two inflation reports won't demonstrate the complete tariff impact on CPI figures, creating a false sense of economic stability. Continuing this trajectory suggests July and August could bring substantial market corrections as inflation data delivers systemic shocks. Furthermore, quarterly reports between now and July will show companies reducing guidance for the year's remainder, potentially creating additional market difficulties. Remember, this represents just one possible outcome. A concerning trend shows many investors withdrawing from growth companies, increasing cash positions, or transitioning to blue-chip dividend stocks. While this approach has merit during normal cycles, extended tariffs would eventually impact these supposedly safe dividend stocks when inflation data and future guidance deteriorates. This creates potential double jeopardy: initial losses when tech declined, followed by secondary losses when blue chips fall in upcoming months due to changing conditions. Investors should carefully consider how CPI data and economic outlooks might influence their portfolios. Again, this assumes prolonged tariff implementation. The third scenario, rapid abandonment of tariff policies within weeks, seems improbable, since the full cost impact won't materialize until tariffs have been enforced for approximately 6 weeks. Without seeing complete economic consequences, no compelling short-term incentive exists to reverse course, another potentially misleading indicator. Don't assume favorable price and inflation reports over the next 2 months represent economic reality. Additionally, auto tariffs activate tomorrow. Analysis just shows varying domestic content among automotive brands. When examining vulnerability based on the proportion of vehicles actually manufactured domestically, electric vehicle manufacturers appear least vulnerable. Coincidence or strategic positioning? That's open for interpretation. The overarching reality is all vehicles will become substantially more expensive, without exception. Even American-branded companies utilize numerous imported vehicles and components. The aspiration to repatriate manufacturing seems unrealistic short-term. Establishing such production facilities requires 4 to 5 years under optimal conditions, and with declining markets, automotive companies have diminished equity valuations, hampering their capability to fund major capital investments, creating compounded challenges. For theoretical consideration, even if manufacturing returned entirely to domestic soil, the workforce necessary to support such industrial transformation simply doesn't exist, necessitating premium compensation, which would force non-automotive sectors to offer competitive wages for the same labor pool. This would inevitably accelerate inflation further. Market sectors respond differently to tariff implementations. Consumer staples and utilities traditionally demonstrate greater resilience during economic uncertainty, while discretionary spending categories often experience more significant contractions. Healthcare generally maintains relative stability regardless of trade policy fluctuations due to its inelastic demand characteristics. Financial services may face particular challenges if tariffs trigger inflation, requiring aggressive monetary policy responses. Understanding these sector-specific dynamics helps construct more resilient portfolios during policy uncertainty. Supply chain disruptions represent another critical consideration beyond direct price effects. Companies dependent on just-in-time inventory systems face particular vulnerability when trade restrictions suddenly alter established procurement patterns. Manufacturing delays, component shortages, and logistical complications frequently accompany major trade policy shifts, affecting corporate performance before price increases fully materialize in consumer markets. These operational disruptions often impact earnings before conventional economic indicators reflect problems. Historical precedent demonstrates tariffs typically create temporary economic distortions before equilibrium reestablishes. The Smoot-Hawley tariffs during the Great Depression ultimately exacerbated economic hardship despite intentions to protect domestic industries. More recently, targeted steel tariffs implemented in 2018 generated mixed results, with modest domestic production increases offset by higher costs throughout manufacturing sectors using steel inputs. These historical lessons suggest caution regarding expectations for quick positive outcomes from broad tariff implementation. Currency markets provide another important indicator worth monitoring during trade disputes. Nations facing export challenges from tariffs often respond through currency devaluation to maintain price competitiveness, creating complex feedback loops throughout global markets. These currency movements can significantly affect multinational corporation earnings and commodity pricing, introducing additional variables for investors navigating trade uncertainty. Given these potential scenarios, prudent planning becomes essential. Investment strategies should reflect individual life cycle positions. Conservative portfolios with substantial fixed income components and sufficient liquid assets to navigate potential economic contractions make sense for those approaching retirement. This observation reflects economic principles rather than specific financial advice. Historical analysis demonstrates that over a 19-year timeframe, missing just the 10 best investment days during bear markets would reduce returns by approximately 50% compared to maintaining market positions. Even purchasing the S&P 500 in October 2007, arguably the worst possible timing before the financial crisis, and maintaining that position through subsequent crises, including European sovereign debt issues, Fukushima, and COVID-19, would have yielded approximately 9.5% annualized returns to present. Market timing strategies typically underperform patient, consistent investment approaches. This current period presents opportunities for disciplined dollar-cost averaging despite potential continued market declines over the next quarter if tariff policies persist. The markets may experience further contraction, but the timeline previously outlined provides perspective for long-term investors. Consider also the potential positive outcome if tariffs successfully establish equitable international trade conditions. This would likely trigger significant market appreciation from tariff removal while simultaneously creating expanded export opportunities for domestic companies, potentially generating substantial rallies across sectors. Current conditions may appear chaotic, but focusing on fundamental principles while disregarding short-term noise remains advisable. Even facing potential stagnation over upcoming months with limited annual growth, periods of widespread market apprehension often present strategic investment opportunities. Several potential positive catalysts exist regardless of tariff developments. The Federal Reserve appears positioned to implement 2 or 3 rate reductions this year. Regulatory reforms and corporate tax advantages could materialize in the year's second half. These business-friendly policy adjustments might generate positive sentiment, driving market gains later this year. The combination of tariff resolution, interest rate reductions, and decreased regulatory burdens could create exceptionally favorable conditions for the year's second half. Preparation before these developments becomes apparent represents prudent strategy. Research focusing on robotics, artificial intelligence, quantum computing, and energy production technologies remains worthwhile for those seeking growth opportunities. Regarding tariffs, these represent the most plausible outcomes and appropriate strategic responses based on current information. As new economic data emerges, analytical frameworks should adapt accordingly. The investment landscape continually evolves, requiring intellectual flexibility and continuous learning. Try maintaining perspective amid sensationalized financial reporting as we navigate these complex economic developments together. Remember that patient, evidence-based investment approaches historically outperform reactive decision-making driven by headlines or emotional responses to temporary market conditions.